Hi there, I'm Lindsay Biscaya. Welcome to Market Call. Barry Schwartz is on the show today. He's president and CIO of Baskin Wealth Management, and he'll be taking your questions on North American large caps. Here's how you can reach us. You can call us toll free, 1-855-326-6266, or you can send us an email to marketcall@bnnbloomberg.ca. And Barry joins us now. Okay, so great to have you once again.
Thanks for having me.
Interesting day. We're seeing a bit of a crash in the markets. Let's say a rotation out of the chip maker stocks. What do you make of what we're seeing? The Nasdaq down by 2%.
Well, it was news to me because I was driving on the 401.
Yeah, it happened quickly.
Yeah, so it happened quickly, and I'm not surprised what's going on. I guess it's a carryover from what happened on Friday. There's a lot of hype. There's a lot of craziness in some of these chip stocks. You know, you're hearing stories about South Korean housewives borrowing money against their houses to buy memory stocks in Korea. You haven't heard that? Well, and you saw like the Korean market was down like 8% follow through from Friday. So, people are getting ahead of themselves with some of these chip names. I know the numbers are staggering, right? We're looking at maybe $1 trillion spent on potential AI infrastructure in 2027. And so naturally, people are going to, want to participate in that. But at some point, you're overpaying for the future, and all the good news is priced in. And, with all these IPOs coming to the market, lots of, we saw a confidential filing yesterday from what's called OpenAI, right? So you got OpenAI, you got Anthropic, you got SpaceX. None of these are profitable. All these are going to be priced as if, perfection has to happen. And in the meantime, of course, high quality, profitable names making tons of money today are being ignored, right? Whether it's names like a Visa or a Microsoft, those type of great quality businesses where we're still using all their products have just been ignored because it's not AI, AI hype.
Is that where you think it's safer for investors to look right now, especially when, like, as you say, like we saw the chip sell off last week, we're seeing it again today after a rebound. Yeah. Like, where do you go to avoid this uncertainty?
If you want to, great question. I mean, if you want to participate in this FOMO, you have to obviously accept that it's going to be volatile. When people start saying, yeah, I bought Micron yesterday and I'm up 15% in one day. Barry, what have you done for me lately? That's not investing. That's gambling. And I don't participate in that. That's just silliness. Maybe it will work out. Not all these AI companies are going to make you a fortune. If you look at past busts of big bubbles, railroads, or the fiber bust earlier in 1999, 2000, some of these companies obviously became some of the biggest in the world, and we're still using railroads today, but a lot of companies are going to go away. So I'm making the investment in high quality businesses that are making a ton of money on their core right now. If AI is additive, fine. I think the returns on the investment in AI are going to be tremendous. And, there's so many pie in the sky ideas here, whether it's people going to space, humanoid robots, self-driving cars everywhere. I mean, the future is happening. It's coming quickly. But doesn't mean that every single company is going to participate. And we haven't even talked about quantum computing, right? Lots of stuff happening. But I think what you have to do as a long-term investor is focus on high-quality businesses that are predictable and making money today. If you want to fool around and be speculative, go ahead and do that. But I'm not going to do that for any of my clients' portfolio. You want to throw a few $1,000s at Micron, go ahead, see what happens. But for wealth managers like us, we can't do that for our clients. Impossible.
For sure. Okay, we're going to take a quick break right now. We'll be back, though, with Barry Schwartz at Baskin Wealth Management, taking your questions on North American large cap stocks right after this. Here's how you can reach us. Welcome back to Market Call. We've got Barry Schwartz on the show today answering your questions. We're going to start with an email from JD, and this reads, "Hi, Barry. Could I please get your thoughts on Brookfield Corporation? I own it, and I'm looking to add to my position. Thank you." Your thoughts?
Yeah, thanks, JD. We also own it and always looking to add to our position as well. We've owned shares of Brookfield for clients and ourselves for probably 20 plus years. Obviously very happy with the long-term results. The stock has kind of, been choppy, obviously, the last few months. We've been seeing some of the, alternative asset managers be under pressure for concerns about private credit, worries about redemption, higher interest rates. I mean, it's always something with alternative assets. But in the meantime, I think Brookfield is one of the better ways to invest in alternative assets. I'd rather own Brookfield Corporation than put my money in one of their products. I think what Brookfield does really, really well is they seem to be always part of any hot theme. They're always coming up with a fund, whether was a carbon fund or whether it's now an AI fund. I mean, they seem to be able to allocate investors' money in a very safe, focused way, more on infrastructure, more on toll road businesses. I think the stock is probably mispriced here. If you ask, obviously, the Brookfield company, they'll tell you that their NAV is probably a lot higher, closer to $80 US a share. But the bottom line is, the company is doing all the right things. They're gathering assets, and it's a pretty good environment for alternative asset managers. With volatile stock markets, people are still attracted to these type of alternatives, and with interest rates potentially coming down in the next year or so, I think there'll be a lot of money still looking to get better returns from fixed income.
Okay, we're going to go to the phone lines now. Paul is calling in from Edmonton with a question for Barry. Hi, Paul. What's your question?
Hello. Yes, thanks for taking my call. I am wondering if we should be buying the silver mining stocks, Wheaton Precious Metals and Pan American Silver right now.
Okay, thanks for that question. What do you think about any of the silver mining stocks?
So I think Paul referenced the streaming companies, right? These are companies that are lower risk. They don't necessarily own the mines. They lend money or take equity stakes in existing mines. Franco-Nevada, very similar. I mean, very good business models, but obviously the valuations of these companies, you're paying up for it because it's a much lower way to play commodities. I have no idea if the price of silver is going to go up or down here. I've referenced this before on your program. If you would have told me that the Iran war would have happened and the Straits of Hormuz would be closed for months and still exchanging fire, and the price of gold is down 20% since the war started. Yeah. So, it's completely random, these movements. I don't think anybody has any insight into what silver and gold prices are going to do. So we don't buy them. I mean, I do feel bad that I don't own a Franco-Nevada type business. There was an opportunity when no one liked gold and silver to buy that. Maybe that will happen again, but I certainly am not going to buy these types of companies and overpay for high commodity prices today that may not be reflective of what's going to happen in the future.
So it doesn't even sound like you have a preference, maybe Franco, but I know Paul also mentioned Wheaton Precious Metals. Do you have a preference or not even?
I'm not the right person to ask. Right. Obviously, if you want to own silver or participate in silver, you'd want to buy a streamer that has the higher exposure to silver versus copper, gold, or oil.
Got it. Okay, back to the phone lines. Charles is calling in from London, Ontario with a question. Hi, Charles.
Hello. Barry, can you give me your views on Royal Bank? I know the valuation is high, but I keep waiting for a pullback, and the stock just seems to be going up in a straight line. Would you get in at this valuation? Thank you very much.
Okay, thank you.
Yeah, boomers rejoice, right? So, you see it all the time where people in the 80s and 90s bought bank stocks for their portfolios. This was well before anybody heard of AI or the internet. And, it's worked out spectacularly. It really doesn't matter which bank you would have bought 20, 30, 40 years ago. They've all, double-digit compound returns with growing dividends. No question, the valuations today on Canadian banks are some of the highest they've been in a long time. For good reason, though. When we talk about the price of stocks, we also have to talk about the context of the environment and what's going on with the economy and what's going on with earnings. One of the things, and I think I have a top pick as a bank today, so checking, yep. I'll leave a little bit dangling. But what I want to say here is, you have to invert it. Why are the banks trading at such high valuations in the past? I think because they've sailed through all these worries and issues with no problems. The worries about the higher mortgage thing never happened. The worries that the housing market in Toronto would collapse didn't happen. Worries about the tariffs didn't make an impact. Worries about the Iran war didn't make an impact. In the meantime, the banks have transformed their businesses to be a lot more fee and recurring revenue, and I think they are worth possibly higher valuations than in the past. And I'll certainly talk more about that at the top picks.
Yes, we'll talk about that a little later. Good tease. Okay, we're going to go back to the phone lines. Perry is calling in from Toronto with a question. Hi, Perry.
Yes, good morning. Thank you for taking my call. I just wanted to know what's going on with Teva. It reminded me of Apotex, Sherman family. Thank you very much.
Okay, thank you.
Teva is an Israeli drug pharmaceutical company that I think is more making generics. I don't think they may have a few drugs that they come up with their own, but essentially generics. So we all know what's going crazy right now. The demand for GLPs, it's a magic pill. It works. Anybody going on it loses a ton of weight and very happy and may stay on it the rest of their lives. On the flip side, of course, the price of as more generics come to the market, the prices of that stuff is going to go down, and there'll be more producers. If you're betting on Teva, you're betting that the demand for GLPs will continue to be strong, that they'll come in pill shape, and that there'll be more amazing drug discoveries. On the other hand, of course, it's not really a very innovative company and should trade at a more reasonable valuation. We've stayed away from the pharmaceutical area. It's just too hard to figure out which companies are going to be the winner. You would have thought Novo Nordisk, they were the ones that came up with the GLP drug that would be a huge winner. And you look at the stock price, it's fallen more in half.
Seems like there's so much competition now, right? With everyone coming out with their own.
Exactly.
Yeah.
Eli Lilly, of course, has been the best way to play that trend. But who knows what the next drug is going to do? Who knows how it's going to be portrayed and which companies are going to be the winners. So I tend to stay away. I think obviously a Teva or an Apotex that may go public soon, Cardinal Health, McKesson, more of a safer way to play that theme, less betting on who's going to win the race and betting on the racetrack.
Okay, we've got an email question now coming in from Sean, and it reads, "Hey Barry, do you still hold Copart, and what's your long-term thesis on this underperforming company?"
Ooh, that's Sean, you be very blunt. Yes, the stock has underperformed recently. Prior to the recent underperformance, it was one of the best performing companies on the New York Stock Exchange or NASDAQ. That being said, we no longer own the stock. We sold it in the mid-30 range. One of the things that's happening with this business, it's in the junk auctions business. So unfortunately, if your car gets into an accident, one of two companies, one is a Canadian company called Ritchie Brothers that owns IAA, and the other is Copart. Copart has not been growing as fast as IAA because IAA is linked to an insurance company that's growing much faster, and Copart really doesn't have a lot of their business. The other issue is in the U.S. because things are so expensive, fewer people are signing up for car insurance. The highest it's ever been of people not driving with car insurance in the U.S.
Wow.
And so if there's no insurance, if you total your car, there's no insurance company to send the car to Copart to be fixed up or sold. So that's hurting the entire business. And the growth has really slowed. So we've decided to get rid of the stock for now, and we'll watch it. We still think it's long-term. It's a well-run business, great balance sheet, but it's not delivering the growth that we'd want it to.
Got it. Okay, we're going to take a quick break right now. We'll be back, though, with Barry Schwartz of Baskin Wealth Management, taking more of your questions on North American large cap stocks right after this. Once again, here's how you can reach us. We'll be right back. Welcome back to Market Call. Barry Schwartz is on the show today, taking many of your questions on North American large caps. We're going to start with an email, this one coming in from Dean, and it reads, "Can you please tell me your views on investing in Stryker at today's price for a medium to long-term investment of 5+ years?" Thoughts on that?
Yeah, thank you. So Stryker makes hip and knee replacements. We started buying this in, I think, 2021. We saw the opportunity. Everybody was concerned when the pandemic happened that no one would be going in for surgeries. So the stock really got hammered. And we said, well, if you need a hip or knee replacement, it's going to happen at some point. You can defer it, but eventually the things are going to recover. So thankfully it did. The stock has been really under pressure of the last, year to date. And I think it more has to do with the overall healthcare sector just not doing very, very well. Other medical device companies not performing well. Stryker admittedly did have an issue earlier this year. There was a cybersecurity attack that really hampered its ability to manufacture devices for a couple of weeks. It's back to normal. They gave guidance and said everything's going to be fine, and we're sticking with our full year guidance for the year. So it's similar to what happened during the pandemic, right? You can't defer getting a hip and knee replacement, but you got to have one eventually. Stryker has the best relationships with medical professionals, arguably the market leader in making medical device products. I think the valuation, Lindsay, is very attractive here. We should see it do about $15 a share of earnings in 2027. So it's around 20 times earnings for a company that's growing top line near 10% a year. So those are very attractive metrics for a high growth company with lots of certainty. Our population is aging, and I see all these people playing cripple ball, me included, and the injuries are going to lead to a lot more Stryker clients.
We'll leave that on a very positive note. We're going to go back to the phone lines now. Jim is calling in from Peace River, Alberta, with a question. Hi, Jim.
Hi. Thanks for taking my call. I was wondering, about Canadian Natural. I like their long-term oil life reserves. Plus, I like it that they have a lot of natural gas. They're in my TFSA. What do you think about them for a 3 to 5 year hold? Thank you very much.
Okay, thanks, Jim.
Well, I mean, the stock's under pressure today for good news. Obviously, we want the Middle East to calm down.
Yeah.
I don't like betting on commodities based on bad news, and it doesn't make me happy to make money when other people are suffering. That's not fun. And the reason why we own Canadian Natural Resources has nothing to do with the price of oil. It has everything to do with the quality of the management, its ability to grow production every year, its ability to keep costs contained, its gigantic level of reserves. I mean, one thing, of course, to watch for, the world is changing quickly. We see China now mostly gone EV. Anecdotally, you'll hear lots of people saying, I'm buying a hybrid, I'm buying an EV, especially with the current oil and gas prices. Those things won't change overnight. Like, we're not China here. So we can't, force everybody to switch cars. But over the long term, that's going to be a headwind for oil and gas. Obviously, we're all worried. I mean, those who like oil and gas now are happy about what's going on, but at some point that's going to reverse.
Yeah.
And the price should fall back to the $60, $70 range. Obviously, you would hope for the economy to do well, for the demand to go there. But we plan to own Canadian Natural for a long period of time. It's doing all the right things. We think it can grow production 3 to 5% a year, and grow its dividend 5 to 10% a year. Obviously, it's making a lot of hay with the higher oil and gas prices today. When things calm down, though, I think the stock will correct a bit. But long term, if you feel you want to invest in oil and gas in a very safe, high-quality management team, this is the best one.
Because I feel like a lot of people might be wondering, when this does calm down in the Middle East, which companies should you be holding, or which should you be worried? But it sounds like you say if they've got good management, it'll be fine.
Well, the higher levered ones, the ones with the worst balance sheets, the ones that make a lot more money when oil prices go up, are obviously going to be the ones that get hit the most.
Right.
Canadian Natural is not in that situation. So it's always traded at a premium valuation to other oil and gas companies.
Okay, back to the phone lines. Charlie's calling in from Montreal with a question for Barry. Hi, Charlie.
Hi, thank you for taking my call. I'm calling about Microsoft. I have a small position in it, and obviously it's been going down with all the others, but the consensus is there's a lot of upside. Would you agree, and what's your take on Microsoft? Thank you.
Yeah. I mean, a lot of these companies, Microsoft and Apple, got too expensive. In 2024, no question. I think Microsoft at one point traded at $550, so maybe got ahead of itself in terms of earnings. It's still growing at double-digit rates. Still going to benefit. I mean, the investments that they're doing in AI. AI is not going away. It's not going to be a zero. And so the companies that have built the railroads are going to benefit for years and years and years. It's kind of like the gold mine. When everybody was looking for gold in the Klondike and we're selling them picks and shovels and jeans and buckets and all that stuff. That went away when the gold prices plummeted and no one could find anything. But the guys who did and found the gold mines make a fortune for years. And I think it's very similar to the Microsofts and the other hyperscalers. It's depressed right now because it's not as an exciting story as the Microns or the Nvidias or I don't know, whatever other crazy company you can come up with. But valuation, very attractive, around 22 times earnings for a company growing double digits. And software isn't going anywhere. So we really like it.
Okay, we're going to talk about another one of those big companies coming up later as well. So we'll take a quick break right now. When we return, though, we'll take a look at some of Barry's past picks. That's next. Stay with us. Welcome back. We're going to take a look at some of Barry's past picks now. These are from September 2nd, 2025, so not quite a year ago yet, but getting up to that point. Your first one, Taiwan Semiconductor, recommended at $228. Now it's at $432, so total return of 91%.
Yeah. That's really
Not bad.
it's really not our type of investment style, right? To buy companies where they double in less than a year. But we'll take it. We're long-term investors. We're looking for companies that grow at double-digit rates. But I'm not, paying up for growth. One of the reasons why Taiwan Semi was so cheap last year is everybody's saying, oh, what about the worries about China invading Taiwan? Mm-hmm. And especially those things got heated up when the U.S. and Iran and those things happened. Yeah. Maybe Taiwan would do something, China would do something to Taiwan. In the meantime, this is the complete bottleneck to AI. There's no more important company in the world, in our opinion, than Taiwan Semiconductor. You can bet on NVIDIA, you can bet on AMD, you can bet on Qualcomm, but Taiwan Semi makes the products for everybody. Elon Musk obviously says, I'm going to build these gigantic fabs and compete with Taiwan Semi. Intel says it too. They've got the capital, but that's going to be years and years away. In the meantime, of course, Taiwan Semi says they have visibility for the next 5 years into demand. Valuation, obviously not as cheap as it was when I recommended it in September, but still not crazily expensive. We prefer this over NVIDIA. We're looking at NVIDIA, but I would rather buy this all day long versus NVIDIA.
And I'm assuming you're still holding this one.
We're still holding it.
Is the headwind for you a potential invasion of Taiwan by China? Are you still watching for that? Or is this company on such a run that it's kind of like that wouldn't be as big of an issue anymore?
Anything can happen in the world. As we see, anything irrational can happen. But the bottom line and why it's not a huge worry for us is Taiwan Semi provides about 15% of its production to China. It's a very important company. China, I think you may have seen it announced, wants to spend $290 billion on chips over the next 5 years. Hello, where are they going to be buying them from? Yeah. It's Taiwan Semi. They're the only game in town.
Okay. All right. We'll move on to your next past pick. It's TFI International. So when you recommended it, it was $130.46. Now it's at $230.72. Total return of 78%. Are you still holding this one too?
We are. We've held it for decades. So we held it through the tough times. I had held it in 2025 when the stock fell in half. I remember a client, I met with a client the other day and he said, I never call you about stocks, but I wanted to call you about TFI and tell you to sell it. And then he said, I'm glad I didn't because the stock's now at an all-time high. Mm-hmm. The trucking business is inflected dramatically higher. We're moving, the economy's doing well. We're moving lots of stuff. Trade is happening even with tariffs. Some of the government actions in the U.S. have restricted U.S. drivers and causing huge benefits for the existing companies. Maybe the valuation is a little bit ahead of itself at the moment, but we love what the company's doing long term. They're great capital allocators, and if things continue, we think great things are going to happen for the company. More spin-offs, more acquisitions. It's really not that expensive if the growth meets expectations.
Okay, your last one is Costco. So we'll take a look at where you recommended that, $938.82. Now it's at $969, so total return of 4%. Are you still holding this one? This is a more expensive one.
We are. We started buying it during the pandemic or in 2000 or maybe even a little bit before. 2020, sorry. I wish I bought it in 2000. I wouldn't be sitting here. I'd be on my yacht. But Costco, it's a high valuation stock. Yeah. But it is growing at double digits, and we expect it to grow at double digits for years. There was a chart that was being passed around the other day showing Costco has the lowest prices compared to all of its competitors on average, grocery competitors, Canada and the U.S. They can't open Costco stores fast enough. There's only 950 stores. We think there's room for thousands of stores over the long term. Just a great business model. But the valuation, obviously, at some point in time gets expensive. But for long-term investors, I'm just going to hold this to the end of time.
Okay. All right. We're going to take a quick break right now. We'll be back with Barry Schwartz of Baskin Wealth Management, taking more of your questions on North American large cap stocks right after this. Stay with us. Welcome back to Market Call. We've got Barry Schwartz on the show today answering many of your questions. We're going to go to the phone lines. Mirren is calling in from Calgary with a question. Hi there. What's your question?
My question for Barry is related to Shell. It seems like it's been a laggard for the last few years. And given their takeover of ARC, I'm just wondering if this could be a turnaround story. And Barry, what your outlook might be for Shell, and does it meet your criteria for double-digit returns?
Okay, thanks for that question.
I think it's done fine over the last 5 years. If I'm looking at the chart proper, it looks like it's doubled over the last 5 years. So maybe it's a laggard, but I think not to single out Moran, but a lot of people have very high expectations in this market, and you shouldn't. You should expect stocks over the long term to deliver 8 to 10% a year. With total return, and that includes dividends. So just because the last few years have been fantastic or the last 10 years have been fantastic doesn't mean anything about what's going to happen in the future. The S&P 500 right before the last bubble went crazy and then did nothing for 10 years. So be very careful about with your expectations for stocks. That being said, on Shell, you obviously know we prefer Canadian natural resources. Shell it has a problem, like a lot of large companies. It's so big, it has to keep acquiring so many assets just to stand still. It doesn't have the type of reserves that a CNQ or a Suncor have it. So obviously they may make more money per barrel of oil because the cost basis it's more expensive to get oil out of the ground from the oil sands. But long term, I think the better way for us to invest is through a CNQ or a Suncor if you believe it long term. I don't really have any opinion on Shell, if it's better than Chevron, if it's better than Exxon. If you feel oil prices are going to stay high for a very long period of time, I'm sure you're going to do very, very well. And the dividends are very, very nice on these stocks. But I would prefer to own companies that have very, very long reserves and can grow those reserves at any time.
Okay, we're going to go back to the phone lines. Darren is calling in from Ottawa with a question. Hi, Darren. What's your question?
Good afternoon, folks. Thanks so much for taking my call. My call today is about copper and your outlook for copper in the next 2 to 3 years. As people raced for the AI build-out of energy and data centers and all that. Wondering what your perspective was on copper and any recommendations if you're bullish on copper. Thank you.
Okay, maybe not look at copper today.
Yeah,
but,
it's barely down. And I mean, look at that move in copper. I'm old enough when I was working in this business. Remember, copper could never break $2, and so now here is a $6. So obviously, the techs and the Hudbays of the world have been working very, very well. What I would say is it's very risky to bet on derivatives of growth of other industries. So just because you think the AI boom is going to continue doesn't mean you need to invest in power and copper and this and that. Because you may not get a pure play on that theme, right? Copper, I don't know how much copper is going to be used for data centers, but it's also used for a whole other bunch of products that could go badly if the tide turns or we have a recession. It's the same thing for investing in a Caterpillar, thinking you're going to make a fortune just because of AI. Yeah, it's moved up huge, but that doesn't mean that other parts of his business can't tank when things change. And if you feel like we do, that a lot of the demand has been pulled forward for the next couple of years, maybe the valuations are already pricing in all the good news. So I'm not really betting on adjacent AI plays. If I want to bet on AI, I'm just going to go right to the source, Taiwan Semi or an NVIDIA, that kind of thing.
Okay, we've got an email question from Rob now, so we'll read that to you. It says, hi, Barry. I've owned Tri for some time now at TRI and took some profit last summer. Is it still a stock worth holding on to? Thank you.
TRI is Thomson Reuters, I assume, and one of the largest companies on the Toronto Stock Exchange. The stock obviously has taken a kick in. Won't say a bad word, but like all software and information tech companies, worries about how AI is going to impact their businesses. We think the most important thing in the age of AI is owning the proprietary data, having data that no AI can get access to and give you answers about. We think Thomson Reuters probably fits that bill. They've collected years and years of information on accounting, on law, on healthcare, you name it, and that data is protected from AI. So I think the demand for their products is going to continue. We already own shares of Moody's, of Fair Isaac, TMX Group, MSCI. These are similar type companies that own proprietary data. And we think those are better run companies. But if I own Thomson Reuters here, I definitely would not sell it, given that the fundamentals are still doing very, very well. The valuation was extremely overpriced. Now it's quite attractive. The Reuters family are the Thomson family, or Reuters family, I don't say them there. Thomson family, owns a big chunk of this company. The history of this company is it's pivoted. It used to be in newspapers and radio. Yeah. Now it's in technology. So let it breathe, give it some time. But I don't think there's anything wrong owning this company here. And I would certainly be attracted to it if I didn't already own other info tech names.
Okay, good to know. We've got a caller now. Raj is calling in from Ajax, Ontario with a question. Hi, Raj. What's your question?
Hi, thank you for taking my call. My question for Barry is on Adobe. For an investor with a 5-year horizon, would you be buying Adobe at current prices, maybe like holding existing shares or looking elsewhere in the software sector for a better value?
Okay.
Thank you.
Thanks, Raj. Appreciate that.
Well, Adobe's trading at a very reasonable valuation if you believe that the past is going to look like the future. The company's growing at double-digit rates. It's buying back an enormous amount of stock. What was disappointing, of course, was seeing the CEO, Shantu, step down recently or announced his retirement. We've seen a lot of retirements of high-quality CEOs recently, right? Tim Cook, Warren Buffett, sometimes for good reason, sometimes not for good reason. But this one kind of mystified us. It looked bad for him stepping down, given the stock price has been plummeting for the past number of years.
Yeah.
I think the stock was probably just trading at way too high a valuation. I am bullish on software. I think AI is going to unlock so many benefits for software company. I think the market has got it wrong, but I'm not sure that Adobe is the best way to play software. I have a top pick, Constellation Software, which we own, which we prefer as our software play, and Microsoft. I guess if you had a capital loss on Adobe, maybe you want to sell it and take the loss and move on to a software company that you have a more conviction in. But, if you're a long-term investor, this is going to be a tough one because things change so quickly. If you think the future is going to be the same as the past, then there's no question this is a screaming buy.
Do you think there's some software companies that might be made redundant because of AI, or you really believe
100% there are. There are companies that are going to be redundant if they don't own the proprietary data or have a proprietary product where they're the book of record. And Adobe is one of those that may be at risk, right? No question, every illustrator, every creative professional will tell you that they're not switching from Adobe, but there are a lot more options than there used to be. There's Canva, there's Figma, Google's coming out with stuff, Meta's coming out with stuff, and eventually these companies are going to say, you don't even need to make ads, we'll do it all for you.
Yeah.
So that's the risk with Adobe, and that's why we sold the stock earlier this year.
Okay. All right, we'll take a quick break once again. We'll be back, though, with Barry Schwartz of Baskin Wealth Management, taking your questions on North American large cap stocks right after this. Stay with us. Welcome back to Market Call. Barry Schwartz still here taking many of your questions. And we'll go to an email question, this one coming in from Mike. And it reads, I took a small position in TMX Group. The stock seems to be performing poorly as of late. Would you sell, hold, or add at these levels? What are your thoughts? Yes. TMX.
Well, so we're long-term investors. You can't expect a stock that you buy to go up every single day and every single month, even when the fundamentals are good. The TMX pulled back along with all other exchanges. It wasn't, only for TMX, with the announcement that the U.S. government is looking to allow these perpetual futures trading on these prediction markets.
Right.
There's way too much gambling going on, Lindsay, and that's not investing, and that's not owning shares of a real business, betting on perpetual futures. And there's worries that maybe it will take some of the option trading away from the TMX group, which has a big options business. And of course, they just acquired a portion of the options business from CBOE, the Canadian and Australian business. But the bottom line is it's very inexpensive. We think it's trading around 20 times earnings. The exchange business isn't going anywhere. They also have very strong recurring revenue from some of their infotech businesses. I think they're a great capital allocator. I think the CEO, John McKenzie, has done an excellent job. There were scandals and issues years and years ago. The company has done tremendous, and we see this as a business growing at double digits for many, many years to come, double-digit earnings growth with a nice dividend increase. So we're actively buying it here at the $50 range.
You're saying hang on. Long term, just hang on.
Not just hang on, buy more.
Just be patient. Yeah, buy more. Okay. We'll go back to the phone lines. Rob is calling in from Montreal with a question for Barry. Hi, Rob.
Hi, Lindsay. Hi, Barry. Your thoughts on Bombardier for a long-term hold? Thank you.
Thank you.
Well, the first thought that comes to mind when I see that stock chart is I'm such a moron for not listening to my colleague Ernest Wong when he pitched Bombardier to me in the $60 or $70 range. And what I got wrong, and it's always interesting to learn what you got wrong. What I got wrong about not pursuing and owning Bombardier is I thought the business jet market would be too cyclical. And I didn't recognize that it's service business. Servicing these business jets is a high value, high margin business. Just like, when you buy a private jet, you customize it, right? Your seats, your carpets, your washrooms, your bed, like whatever. And so we missed that. The demand for business jets is insane. There's so many rich people out there that hate flying. They'd rather throw money out the window and spend $20,000 to fly them and their friends to Florida. I ain't going to do that, but lots of people have more money than problems, and so this is what they're spending money on. The valuation right now is probably out of control for Bombardier stock. You're paying a high price right now for still a cyclical business where bad things can happen in a cyclical business at any point. If we tip it over to a recession or, God forbid, any macro worries, you don't want to own Bombardier. And there's still the tariff issue that could rear its ugly head. So I think you're paying a high price right now for a rosy future.
Okay, we'll squeeze in one more question. We've got an email coming in from Elaine, and it reads, may I ask Barry what Barry thinks about MDA Space? Thoughts on this company? Yeah, so obviously everybody's excited about space right now. This is not a company that is going to benefit from SpaceX IPO. This is, they put satellites in the sky. There's going to be a lot more competition with Jeff Bezos' Blue Origin, with SpaceX, and a lot of fat wallets going on. I think it's, it is profitable, but it's trading at 40 times this year's earnings. That is just hype. This is not a company that should be trading at 40 times earnings given its growth, maybe double-digit revenue growth, but lower earnings growth, very capital intensive, and there's a lot of hype there. I would be more attracted if the stock was trading in the low 20 times earnings. Interesting. Okay, we'll take a quick break right now. When we come back, though, we will take a look at some of Barry's new top picks. Stay with us. Join us tomorrow on Market Call. Kim Bolton will be on the show. He is president and portfolio manager at Black Swan Dexteritas, and we'll be taking your questions on technology stocks. And if you miss Market Call, you can always check out our daily podcast. You can find it on iHeartRadio and other platforms, and you can also watch full episodes on our YouTube channel. Okay, time now for top picks with Barry Schwartz. I believe we've hinted at all three of these today throughout the show. So probably. We'll start with the first one. Meta is your top pick. Lots of opportunity here, I'm assuming. What do you see in Meta? Yeah, so the stock has really underperformed, I guess, the AI trade. Obviously holding up well today in a bloodbath of tech stocks pulling back. And that's because it's crazy profitable. I think Meta is going to earn close to $30 a share in earnings this year, so you're paying less than 20 times earnings. It's proven to everybody that AI is accelerating its business. All you have to do is look at the revenues over the last 2 quarters. Meta, unlike Google, unlike Amazon, unlike Microsoft, is not reselling its compute at the moment. It's only using the compute for itself, and you're seeing it in the revenue growth. What scared the market was obviously Google selling $80 billion worth of stock. By the way, that's a rounding error, and it's meaningless, and that stock's going to be sold over 3 years in time, and probably a smart move, Google, to take advantage of the higher stock price. There was worries that Meta is going to do the same thing. I don't think Mark Zuckerberg is going to issue stock at these levels.
Could be wrong, but that's obviously a headwind right now. Everybody is just stunned about how much they're spending on AI, but the growth is there. So to get Meta going again, you're going to have to see strong revenue growth. I think you're going to see that this quarter and going forward. Everybody's addicted to their phone. Nothing is changing, and even more so as the AI tools get better. So we really like it, really think it's inexpensive, and really love partnering with Mark Zuckerberg.
Okay, next up is National Bank. We were talking about some of the banks earlier today. We have not talked about National Bank, though. What is it that you like about this one? Yeah,
so I didn't pick this as like it's the greatest stock pick ever at this valuation. But what I was alluding to before with the Royal Banks, I do think the Canadian banks deserve to trade at higher valuations versus in the past, especially companies like National Bank and Royal Bank, which are very much focused on wealth management and fee for service type businesses. Obviously, they're making tons of hay with the volatility in the market. That's good for their trading and proprietary businesses. With markets up, there's more IPOs, there's more secondaries. Obviously, they collect higher fees on wealth management. These are great things. I love the Canadian Western Bank deal that National did. I think they did it right at the best time for oil and gas sector when things were quite low. I think they'll be able to sell more wealth management and other services to Alberta and Western clients as going forward. Valuation is not that expensive at 15 times 2027 earnings, and we think National Bank can deliver double-digit earnings growth for a long period of time. Obviously, you're paying a higher valuation, so don't expect to make 40% going forward on National Bank, but I still think you can still do a high single-digit, low double-digit returns over the next 5 years, total return owning National Bank.
Your last one, we just teased this, I think, in the last block, is Constellation Software. So this is your last top pick. What is it that you like about Constellation Software compared to some of the other software companies?
It's insanely cheap. It's insanely cheap, and unlike any other software company, not diluting investors with share compensation, continuing to be aggressive when others are pulling back. The amount of capital that's put to work this year is way more than anybody would have expected, and it's not even been a half a year yet. The company, when other people are saying, AI is going to ruin software, they're going so quickly trying to implement AI services into all their software, as well as take advantage of depressed prices for software companies. We think this company should be trading at a much higher valuation. Admittedly, I probably got too greedy when the stock was over $5,000 a share. Probably should have been more aggressive trimming the stock. Valuation was high, but that's all in the past. And what I'm looking for in the future is double-digit earnings and revenue growth for a long period of time, and as the company continues to grow and add more software names to its roster.
Do you think Constellation might be like a takeover target?
No, because it's a very niche-y type company. It's more of an investment company that uses cash flow to buy other software companies. The only logical buyer would be a Berkshire Hathaway if they ever wanted to get into software. But I think Mark Leonard tried to pitch that to Warren Buffett years ago, and that didn't work. So
we just have 1 minute left here, and I just wanted to circle back one more time and take a look at what the markets are doing today, because we're seeing the NASDAQ now down more than 4%. Chipmaker sell-off happening just in our last 30 seconds or so. A quick reminder to the viewers that are watching: what are you doing when we're seeing this volatility today?
Well, right now I'm sitting here with you.
Yeah, but I mean, are you go ahead.
I'm a long-term investor, and what goes up must come down. It got too easy for people buying all these chip stocks, going straight up. You saw we own Taiwan Semiconductor. If it falls 25 or 30%, happy to buy more. I don't think it's our best idea at the moment, but I love it long term. And I don't think we're going to be using less AI going forward. We're going to be using a lot more. So pick your spots. Got it. Okay, we're going to leave it there. Barry, I always appreciate you joining us. Thanks so much. Thanks for having me. And thank you for watching Market Call. We will see you next time.